Okay, we have our next and largest panel. So if all the panelists will start moving up. This one is about taxes. After a day of, at least an afternoon of legal, we're getting to the tax part of legal and tax. And this is simply stated, the Taxman Cometh, NFT taxes. Can't wait to hear this. And our panelists are Zach Mcclure, Florian Zawodsky, Pat White will be replacing Amy Kalnoki, Maneisha Sandhu, Karl Nicolas, and Olga Bashkatova. Panelists.
Testing? Yeah? Okay, great. All right, welcome everybody. So our panel is the Taxman Cometh, NFT taxes. So we have a really great panel here today. We also wanted to let you know that there's a POAP for this panel that you can download through the app, and there's a secret word. It's We Love Taxes 2022, right? It's taxes, okay. So our first question will be focused on individual taxation. And so we had $17.5 billion worth of NFT sales last year. And so for anyone who hasn't filed their 2021 taxes yet, let's hear from the panel about what your recommendations are for how they can do that best, what they need to be looking out for.
Well, I think we're going to start with introduction first. I'm Karl Nicolas. I'm with Ernst & Young National Tax Practice in Washington, D.C., and my practice focuses on multi-state sales and use tax policy. If there's one thing I want you to take away from this session, if you take away nothing else, it's that everything you do has a tax consequence. You're born, you die, you buy a house, you sell a house, you get married, you get divorced. At some point, someone from some revenue agency, whether it's federal, state, or local, is going to come looking for their pound of flesh. And the problem that we're seeing with this now is that they're trying to kind of crowbar new ways of doing business into these old, outdated, antiquated tax systems. So the problem that we're seeing is obviously they're applying these on an overly broad scale, and we're getting bad tax policy out of it. So if nothing else, just know that the tax man is indeed coming, and if you don't start planning for it now and you don't start thinking about it now, you are not going to like the result.
Bum, bum, bum. Oh, hi, everyone. I'm Maneisha Sandhu, and I have a Canadian tax practice that helps businesses and individuals, and I also do fractional CFO, COO roles, and I have some really amazing clients and people that I work with. Some of them are here now. I have a team from Voxy's here to support me, so thank you. Always Geeky Games, yay. And then I also am a fractional CFO for Boss Beauties. I don't know if you've heard of them, and a few others, so it's really exciting, and I'm really happy to be here. And yeah, I've learned a lot this year, and I'm sure we'll get into more, but I don't want to take up too much time. So, Pat?
Yeah, absolutely. Hey, everybody. My name is Pat White. I'm the CEO of Bitwave. I'm filling in for Amy, so she got sick before coming out here. So my take on all this is Bitwave, we focus on enterprise digital assets, so how this impacts businesses. So kind of my take will be a little bit on more like the creator side and then the marketplace side. That'll be where I'll add my 2 cents on these things for like the businesses that are really part of this, and I'll defer to everyone else on the individual side, but really great to be here.
Hi, I'm Zach. I'm one of the co-founders of Token Tax. So we create software for individuals who are trying to file their personal taxes, as well as, hey, I started an LLC, I started a company. Can you help me figure out the crypto gains, loss, and income for last year, this year, multiple years? We're basically just trying to demystify how complicated this is. As you heard, apparently, the tax man is coming, and so we're just trying to, I hear too many times like, oh, I don't even want to get involved in NFTs on this blockchain, et cetera, because I know the taxes are going to be so difficult. And so we're trying to create software that solves that, and then people whose situation is more complicated than the software can handle, we kind of like have a special situations team that does those VIP or enterprise reconciliations, DeFi, multi-chain, et cetera. So thanks for having me.
Okay, I will add up to this. My name is Florian Zawodsky. I'm from Germany. I'm a tax advisor working in the same firm as Karl at EY. I'm based in Berlin. I think I will also start with my main message, but somehow it all sounded quite bad. But I would actually see the taxman coming. I want to see it in a positive way. it's actually, in my mind, also some kind of opportunity in two ways, especially for us law and tax people, because it's an interesting topic. We can have a discussion here. It's not really old, it's new. That makes it interesting. This is cool for me. And on the second part, I feel I speak to a lot of startups here who basically, like the NFT projects, a lot of PFP projects are about building community. And I'm like, okay, take a step back. We are already in a community, like where we're here, and we have already agreed since ages that we pay taxes, we contribute to this community by paying taxes. So think of your taxes, do your homework, pay your taxes, because it's actually a good thing. It's an investment into the big community and not just in your 10,000 people PFP community. That's for my introduction so far.
Awesome. And I'm sorry I forgot about the introductions, but I'm Olga Bashkatova. I own an accounting firm, Next Stage Advisory, and I work with companies in Web3. And so my takeaway, honestly, for last year, I've been kind of harping on sales taxes on NFTs. I think every company that issues NFTs really needs to look at this because that's real. Anyone who keeps arguing that sales taxes aren't due on NFTs because NFTs aren't real, like they're not assets as we know of assets, before that, or that because they're crypto, they're not subject to normal taxation rules. That's incorrect. It's a myth. And so we're going to delve more into that today in later questions. So, and now we're going to segue into the question about individual taxes and what you guys think they should focus on.
I might start on that, and I also would basically split my answer in the quantitative and the qualitative basis. So I know that no one is interested in the German tax system, but we basically have questions on every end. Like even if you didn't even think of NFTs, just Bitcoin. If you sell one Bitcoin, you could come up with millions of questions, even constitutional questions. Might be taxable, that's what the major ideas or what most people think, but you can come up with a lot of argumentation that it's not. We published an article about airdrops. If you sell them, is that taxable or not? We don't know for sure, so the courts will tell. So this is on a quantitative basis. So basically, every transaction has to be valid on its own, and even what you might think easy transactions would be are quite tough. And on a qualitative basis, like I have a client, he did some DeFi stuff, and it's around 200,000 transactions for 1 year. And in Germany, this income is in the same section as income if you were to sell one house or two old timers. So you see where I'm standing at. This is a big problem. We have to use tools. I haven't really found the best tool, but I think Zach can take up on that.
So yeah, we're building one of those tools, and as everybody who does their crypto taxes probably says, not perfect, but the software takes time to develop. But one of the most important things I could say is for everybody who's investing in crypto, investing in NFTs, an ounce of prevention saves a pound of cure. Before you end up with giving your accountant 200,000 DeFi transactions and thinking, oh, I traded a lot on Coinbase Pro. I had 200,000 transactions last year. It was no problem. Well, 1,000 transactions on Solana, if there are no integrations, can be exponentially harder than 200,000, on Coinbase Pro or whatever, Gemini. And so I really recommend you try a software, see, are the reconciliations making sense? And a few big things are crypto's down a lot right now. So you can sell NFTs, crypto at a loss, buy like a correlated asset, even if wash sales do end up applying or get retroactively applied, or you live in a jurisdiction where they do. And 2021, hopefully you already filed. If you haven't, you're on extension. You still have plenty of time. 2022, and again, before the end of the year, you can actually go and sell things that are underwater, get that capital loss in that actual year, because capital losses don't carry backward. So now we have a number of people who made a lot of money in 2021, didn't set enough aside for taxes, and are now maybe upside down. And we're going to talk about this in a bit, but also for companies, a lot of entities here are doing like ETH NFT launches. You get $2 million in ETH, leave it in ETH, and now it's dropped 70, 80% in some cases, or even 50%, and they may owe more in taxes than the ETH is actually worth now. And capital losses do not wipe out ordinary income. And so, again, an ounce of prevention saves a pound of cure. And maybe that segues to the second question.
Well, I think Maneisha also wanted to speak on this.
Oh, no, that's okay. I actually have a question. By a show of hands, who's filed their taxes? For a second, nobody
Excellent.
raised their hand, and I was going to be like, okay, you came to the right panel. By another show of hands, who's hodling? Holding. Come on, you guys. You're at an NFT conference. Okay, so some of you are down. By a show of hands, are some of you down? Okay, so you want to know what to do when you're down? Yeah? Okay. So I got a really strong yeah. So Zach mentioned lost harvesting. So there's a few differences between Canada and the US. And I should put a disclaimer because I don't think we did, but none of this is official advice. We're not your accountants. Please don't construe this as advice, informational purposes only.
It's amazing. We got 8 minutes into a conversation like this without saying that.
Oh
That's
yeah,
like
no, but I've said
incredible.
it now. Thanks, Pat. So one thing I'll say is in Canada, these wash sale rules, Google it if you don't, we're not going to talk about it here, but Google it if you have time after. They have similar rules in Canada. They do apply in Canada, but they don't apply in the States, okay? So before you start to lost harvest, check out these wash sale rules or superficial losses in Canada because that can help. They may deny your losses, essentially. Another thing, if you're down and you want to get around these wash sale or superficial loss rules, I would highly recommend if you're going to switch to another, you can switch to another currency. Like instead of holding ETH, you could hold USDC, for example, still holding it in a sort of cryptocurrency. And as long as you don't fit it within that 30-day buyback period, the loss will be realized. So the key is figuring out how to realize those losses, okay? So I'll get you guys on a little bit of a
Does Canada let you do
chase.
things like ETH to WETH or BTC to WBTC? Would that be an equivalent?
Yeah. Oh, that's a great area,
area.
Pat. So I think people are taking the position that it would, but it hasn't come out yet. So there's no legislation, and there hasn't been any case law to support that. But I think it's probably safe.
Yeah, so even if you're taking a less aggressive stance, there are other ways to get exposure to other assets that can actually get you a nice loss harvesting, even if you want to be less aggressive than just doing the BTC to USD right back. That could be construed as not okay by your tax authority.
Yeah, I think just, remember, some people think wash sales don't apply in the US, and they might not, and there is no guidance, but there's something called economic substance. If you sell something at a loss and immediately buy it back, the IRS could always just disallow it and say it lacks economic substance. And there are some court rulings about like selling the SPY and buying the VOO, which are both S&P 500 ETFs. And they ruled that lacked economic substance. So be very careful. Like, for one, if you're gonna do ETH to WETH as a taxable event, make sure you do that consistently across all of your transactions and forever until they actually give guidance that says, oh, you were doing it wrong, then you could change. But otherwise, you gotta be consistent, and I'd say conservative.
Awesome. Thank you so much. And if you guys have any more questions on this topic, you can ask it during Q&A. We'll save a few minutes at the end, or obviously find them outside. Everybody's super professional here and knows what they're talking about. But let's move on to corporate taxes. And so if a company is in the business of minting NFTs and selling them as their primary source of income, or they're trading NFTs on the side, what are the things that they need to consider when they're filing any sort of taxes?
Is this for me?
Sure.
Yeah. All right, because I'll take this one. So this goes, and it goes, I'll say that this applies for companies that are doing this as well as like individuals. Like if you just decide to do a drop, like you are a company for those intents and purposes. I mean, you're an individual, blah, blah, blah. But like at the end of the day, it's the same stuff, which is that you are essentially, you put out the drop, you get ETH, that is revenue. You have to basically, any tokens that people are giving you that is in exchange for pretty much anything, but let's call it for pictures of monkeys, you need to basically fair market value the Ethereum, the Bitcoin, whatever it is you're getting, the USDC. That one's pretty easy, but Ethereum can get a little bit tricky. You have to fair market value it. You have to recognize it as either income, or if you're in a business, you have to recognize it as revenue. In businesses, you can do a few other clever things. Like you can do really cool stuff. Like you can write off some of your expenses around actually doing the NFT drop. So your gas fees and stuff like that are expenses that you could write off. But you still have to be recognizing the revenue. You have to track those tokens with a cost basis attached, so that when you go and sell them, you need to pay taxes on them. It's a tricky part of the hardest part of crypto in general from the business perspective is that every transaction is both accountable, that you need to get into your general ledger, you need to track the revenue, and then it's also taxable that you need to then track the tax component of it. So you're picking that up as a business. It's very important. I didn't mention this when we did introductions, but if you take one thing away from me on all of this is do pay your taxes, you guys. I know it's not necessarily the most popular opinion, but like it's good to pay your taxes.
It'll save you in the long run. Can I add on one thing? So one thing I've been seeing and helping the most businesses, NFT projects, crypto companies with is the wallets do not exist in the company. They hold them personally, they incorporate, or they have a KYC'd exchange account in somebody else's name, and then they cash out through that KYC'd account. The government authorities want to see that you're holding it where you're claiming it. So it's got to be in your name or in the business name. So make sure when you're setting up a business that you set up a clean MetaMask or decentralized wallet for your company or for your business, and then a clean exchange account that's KYC'd in the name of what's generating that revenue.
And that's not just tax advice. Well, none of this is tax advice. But that's not just applicable to tax reasons. Like, if you do that as a corporation and you have that, you've created a potential piercing of the corporate veil. Like, that's why the first thing you do when you set up a business in the US is you set up a bank account. The first thing, if you're going to set up a business, and that even goes for, like, if you're just going to sell some NFTs, set up a separate wallet where you can track it. It's not just great for this, but also will just help your taxes. Because
It's also
the other
great
side,
for your accountant,
oh
though.
my God, your accountant will love you. The day that you hand them a wallet, says like, this is all revenue, these are all like minting expenses. It makes your life so much easier. With like Bitwave, where you can write a rule that just automatically categorizes all your revenue, automatically categorizes all your fees. It's super easy.
Karl?
And we can't avoid the indirect tax implications of this. Right now, the states are kind of coalescing around whether or not these things are taxable. A couple weeks ago, the Deputy Director of Tax Policy for Washington State came out, and I'm paraphrasing here, but he said, boy, these things sure as heck look taxable. And there's a lot of money changing hands, and it comes down to the question of how long do we want to wait before we start taxing these? So if you're a business or if you're an individual and you're selling these things, there's potentially a sales and use tax obligation. If you're buying these things and the seller is not charging you sales tax, there's a potential use tax obligation that you have. It's difficult to say where it's going to go, but right now it seems like they're just going to kind of lump these in because the states like to make everything as simple as possible and say, these are digital goods, either we tax it or we don't, and if we do, these are subject to tax. They're not going to look through the contract, they're not going to look what the underlying transaction is, they're just going to look at it and say, digital asset, we have a T next to that on our state matrix, it's subject to tax, you need to register, collect, and remit the tax, otherwise we're going to come looking for you.
Yeah, I was going to say, it's actually not hard to anticipate where it's going to go. I mean, like, states are going to get theirs. Like, there is absolutely no doubt that taxes are going to apply to this. The hardest part, of course, is like how you figure it out. I assume that's where we're going.
Like if I can add up to this, to that, from a European perspective, it's the same thing. We have a VAT, and it even should be stricter than sales and use taxes, because from what I get from the US side is that probably not everything is taxable. For us, everything is either a supply or a service, and every now and then everything is something is not taxable, but if it basically the situation when you offer NFTs or let them people mint them, there will be tax on it. And I think what Karl just said on the states that we don't know how it is, it's the same for all the member states in the EU, but eventually it will end up as being taxable events if you sell on primary sales, if you probably also when you have secondary sales. So it's a good idea to worry about these questions, and probably even before you start.
And what I wanted to add is that, of course, it's also important to establish who owes these taxes. And so to the prior discussion, I've definitely seen some companies, they kind of, they do a partnership. It's a couple of guys, they launch a bunch of NFTs, they sell it for millions of dollars, and it's not clear because they don't have contracts who actually owns all of these transactions. And obviously, as lawyers, accountants, and tax people here, that is very important, because who is the IRS or any other tax jurisdiction going to come after, right? They're going to look at kind of, well, whose community is this, or other factors. And so it's really important that contracts are properly delineating who owns the transaction, because that's who is going to most likely own the tax liability. And then I also think it's really important that companies start looking at sales tax studies to establish their nexus so that they understand where do they have a presence, where do they have the liability to collect and remit sales taxes. And that's what accounting firms are for, like Deloitte, EY, they all, and mid-market firms, they all do sales tax studies here and abroad.
Can I just add one thing to that really quickly? It's also way trickier when you're dealing with multiple jurisdictions, which is why we have such a colorful panel here. So that point that you made, Olga, is so important, because if you're also dealing in multi-jurisdictions, who pays the taxes? Which government gets that piece? And hence, the taxman cometh.
Yeah, and it might be relevant to add, onto what Olga said, for DAOs, like if you own 10% of a DAO and that DAO made $1 million, you personally, the taxes probably flow through to you, and you probably owe $40,000. Even if you never got any money, the distributions are not the taxable event. It's when it's earned by either the LLC or the company you own, or if you didn't set up a partnership and it's just a DAO, it may just be a partnership without a legal structure, but you still may owe the taxes. And so a lot of DAOs that we've been talking to have kind of like didn't plan ahead on this, and they don't know who some of the members are and XYZ. And as she said, the revenue authorities, who knows what they're going to say if you come to them and say, oh yeah, only 10% of this wallet's mine. And so.
And on another note that's related to this, we also need to start understanding where the customers are, because Nexus very often depends on where your customer is. And most of the companies in crypto right now, they're not KYCing, they're not collecting information about where these people are. There are also considerations from the Tax Act from last year about, do we need to issue 1099s about transactions, crypto transactions starting as of next year? And for that, you need to have information about where these people are. You need their social security numbers. So these are all huge changes that would need to be made to the whole industry. And every single company may have to start collecting this information. So it's something to consider.
And if you can't source it, and you can't justify that sourcing, a lot of times you're going to have multiple jurisdictions coming at you, and there's nothing to prevent you from having double jeopardy on these taxes.
What we're seeing from our customers is, because we work with all the business exchanges, I can't speak to any of them individually, but what we've tended to see from our customers is they actually are doing a proportionate distribution analysis, where they look at the population of Wyoming versus the whole United States, then they assume that many people, that percentage is actually using and doing it. It's imperfect, but it is one of the methods to do it. If you're a creator, like that's a lot of overhead to do that kind of stuff. So just be aware of that.
And one of the best practices we see in regard to that is, if the state hasn't given you a specific way to allocate this, you can do it multiple ways, and there's no reason that you have to pick the way that best benefits the state. If you have something that's reasonable and justifiable, you can use that.
Awesome, thank you. And I think we're running out of time because we need to do Q&A now. So we have a couple of minutes for Q&A. Go ahead.
Maybe I can take that. Virtual, that rings bells in my mind. We had a court decision in Germany. Someone sold in Second Life virtual land, or he basically rented it, and it was kind of interesting, especially like from a tax perspective. Like the first instance said it's a taxable transaction. Second, like the federal court said, it's not a taxable transaction. It is interesting, but it's also really tough to identify if Second Life is really the crypto world. Obviously, it's not, but it's probably closer than real life, leasing real land. But these are the questions we basically have to deal day in, day out. Is that a similar situation? And for Germany, obviously, your question is probably not just aiming for Germany, but it's really tough. And this is a perfect example that it is really, it's the small differences. And if you have something like Second Life crypto, similar, but certainly not the same, so can't really tell.
Anyone else?
Or should we take one more question? Go ahead.
Probably not, but probably a gray area. I mean, maybe you can amortize it.
You're gonna split it up between probably, because it's actually one of the most interesting parts of all this is like, even from the other side, like let's say you're Yuga and you sell an NFT that has access to the other side and it has the art value and it has all these things. How you actually apply the revenue is totally different too. So you're gonna want to split up the revenue rec.
I'm hearing an it depends.
Well, because a lot of people are like, hey, if I buy $10 million of NFTs in December, do I get to take that as an expense this year? And you can kind of see the slippery slope there of why this probably not going to fly. It might be related to your question about land. Should you amortize land the way you depreciate, buildings in the real world or whatever? But probably it's more like a capital gain or loss when you sell that land.
So what I'm hearing is you should probably talk to an accountant.
Talk to your tax professional.
Well, thank you, everybody. You were great.
Thanks.
Thank you. So I thought the question was interesting because I think the way I heard it was, if access to the community is a business expense because you need to be in that community, like joining a club, is part of that NFT deductible? That's a good question. It depends. Okay, there we go.